The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe, addition of the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I'm going to begin, as I always do, by saying thank you. Thank you for taking the time to join us today, but also thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough. You'll always hear it here. I know podcasts are supposed to exist outside of time and space, but our recording day today is on the day of the first federal government shutdown in 7 years. And if you've listened to my various podcasts, our various podcasts, you know where I come down on this. This was never meant to be a legislated lever of government. Okay. So I'm appealing to both sides. Okay, you let the shutdown happen. You just proved that you're serious. Now, please get together and pass a continuing resolution or preferably a budget so that we can get back to the business of taking care of the American people and also so that we are not continuing to hurt our feds. So I'll get off that soapbox for now. Ed Zerndorfer is back with us once again. The Guru is here as part of our ongoing mission to reach, teach, and serve you. Once again, we're following Ed's FedZone articles, one more way for us to reach and teach. And today, we're covering a series on life insurance for federal employees because we just completed September, which is Life Insurance Awareness Month. And Ed's article is very timely, and it covers the 8 most common mistakes people make with their life insurance. This is critical stuff for feds who want to protect their families. Okay, Ed, I see a lot of federal employees who think, for example, that their FedLife coverage is enough. But your first mistake talks about inadequate coverage. So what should our feds be thinking about this?
Yes, Dan, as you mentioned, during the month of September, which has been called September Life Insurance Awareness Month by a company called Life Happens, all my columns during the month of September, all 4 columns dealt with life insurance issues. And I do this every year because life insurance, yes, it is an insurance and an important insurance. Not everyone needs it. I'll be the first to tell you that. But if you do need it, individuals have to know what they're buying and why they're buying it. What's the reason? What's behind it? How much life insurance to buy? Things like that. That's one of the biggest questions that comes up. So when a federal employee, just to give you, we're talking about FedLife, when a federal employee enters federal service, a permanent employee, either full-time or part-time, they are automatically enrolled in the Federal Employee Group Life Insurance Program. This is a group sponsor plan. The sponsor is the federal government, in which employees can enroll with what's called guaranteed issue. Guaranteed issue means they don't have to go through underwriting, no health questionnaires, no doctor exams, nothing. They are, in fact, automatically enrolled in what's called the FedLife Basic Insurance Amount. What is that? It's their salary, their current year salary, as shown on their SF50. A little slight adjustment upward when it comes to FedLife Basic Insurance Amount. So the employee, if they don't reject it, they're automatically enrolled. Now, they can also have the option within the first 60 days to enroll in optional coverages. But this begs the question about, as far as the employee is concerned, why do they need life insurance? Or do they have, if they have FedLife the basic insurance amount, is that enough insurance? I have an insurance license. I'll be honest with you. I do not sell insurance. Most of my time is helping individuals buy insurance policies, what type of insurance. But one of the biggest questions comes up is, how much life insurance do I need? That is a very important question because, you can buy life insurance policies now, maybe, as little as $10,000, $20,000. You can go all the way up $1 million, $2 million. But the question is, how much life insurance does a person need? And it comes down to a simple question. When someone says, they ask me that question, how much life insurance do I need? I say, what is the purpose of your life insurance? Why do people buy life insurance? I'll give you a couple reasons. One, to pay off a big debt, like a mortgage. Two, maybe to pay future estate tax, estate settlement costs, things like that, pay for a funeral. But perhaps the biggest reason that people buy life insurance, individual life insurance, is income protection. Income protection for family members. This is probably the most important, the most common reason to buy life insurance. So, how much, given the fact that someone is buying life insurance for income protection, the question is, how much insurance should I buy? Essentially, what the person's asking is, okay, I'm working, I'm bringing home a paycheck, and that paycheck pays for my family. For what? Putting food on the table, paying for monthly expenses, utility bills, paying for, if you have children, raising the kids, putting them through school, paying for future things like weddings, things like that, paying for college. So the question person is, and I'm sure that many of our listeners have heard this on TV. If John dies, what's going to happen to his family? How will they pay their mortgage? Things like that. And that's the reason they buy life insurance. So how much life insurance does one need? How much, if the question is income protection? I'd like to just share with you a statistic I came across when I wrote the column. It says that the average total cost to raise a child today, Dan, through the age of 21, excluding college, is $250,000 per child. $250,000.
Wow.
You throw in college, it'll probably be, in today's dollars, probably closer to maybe a $350,000, $400,000, maybe as much as $500,000, including everything.
Sure.
So we're talking a lot of money here in terms of what's going to replace that paycheck. So the question comes up, well, how do I know what you're saying, Ed, when I have discussions with clients about that, but how do I determine how much I need? I still am unsure what to do. What should I do? Determine what do I need to do to determine what should be the face amount of life insurance I should buy? How much? And of course, the other question is, for how long? So we'll get to that question here in a few moments. But the question, how much life? So how do you go about determining how much life insurance you need? I mean, the insurance companies will throw in some things like, well, take your annual salary, annual gross salary, and multiply it by 8 to 10 times. I'm not so sure that's too simple in my book. I'm a financial planner. That's taking the easy way out. I think the person's doing themselves a disservice by just going by that simple way. My feeling is that if you really have no experience in determining, future costs and things like that, you need help, you should talk to a licensed insurance professional. And they have the means of determining what the real amount of life insurance one needs. They're going to ask a lot of questions. Tell me, what are your expenses? Do you have a mortgage? How many children do you have? Run the numbers. I know, Dan, when I was selling life insurance policies, this goes back 20, 30 years ago, when I would meet with clients and I would bring my pad, I'd bring my calculator, the batteries of my calculator would burn out. I was doing calculations in order to determine the amount. And it really
Sure.
wouldn't be just one meeting. I'd have a couple meetings. We have to go over things in order to determine the dollar amount. And this is a very, very important thing to do, that individuals should remember when they're buying life insurance. They have to have an idea. One, how much they need and for how long.
Sure.
For how long.
Absolutely.
And an insurance professional, someone who is licensed in insurance, someone is, who has a background in doing this. This is someone that I feel I would recommend.
Gotcha. Now, Ed, you say the second mistake is buying the wrong type of life insurance. What do you mean there?
Well, there are two types of insurance policies, Dan. One are term policies, and they pay a death benefit. There's no cash value. They have a set term, as little as 10 years. I've heard now they go out to as many 40 years. I know, Dan, you have a little more experience in this than I have because I don't put policies, but now some insurance companies will go out for 40 years.
Very true.
But the point is there's only a death benefit, and if the person dies within the term, the death benefit is paid to named beneficiaries. But if the individual outlives the policy, if they bought a 20-year term policy and they died in year 21, nothing is paid. Nothing is paid to the beneficiaries. On the other hand, permanent life insurance policies, also known as cash value life insurance policies, go on. They go on indefinitely. Provided that the person, that the policy owner pays the premiums, and they also build up cash value. So if a person knows for a fact they have, a limited need for life insurance coverage, the idea of paying more for permanent, because permanent life insurance is more, probably doesn't make sense. Let me share an example of someone who has a temporary need for life insurance. So let's take a young family. Both spouses are working. They have children, and they buy a house. Let's say they buy a house in their late 20s, early 30s. Take out a 30-year mortgage, and they figure after 30 years they will no longer need life insurance. Why? Because the mortgage will be paid off. The children will hopefully be, I use the word, financially independent.
Hopefully launched.
I said my 4 adult children are not tax dependents, but in many ways I feel sometimes maybe they need some help in terms of finances. They still depend on me when it comes to finances. Okay, but the fact of the matter is, if all goes well, the children will be financially independent. The mortgage will be paid off. The need for life insurance may not be there. So buying a 30-year term life insurance policy would be more appropriate. However, that being said, that does not mean that when you buy that policy, when a couple buys that policy, they're done. That's it. They don't have to worry anything more, because something may come up. Let's say within the next 10 to 15 years, that may necessitate them extending the life insurance, the term policy. So here it is, let's say 15 years into the mortgage, they got 15 more years left in the mortgage, but then they refinance, and they take out another 30-year mortgage.
Absolutely.
So they may have to buy, let's say, a 20-year term policy in addition to that one to cover the new mortgage. So it's not, well, all done, all set, and you constantly have to be reevaluating your life insurance needs.
Gotcha. And that that brings us right in, great segue, into mistake number 3. And that's where people who haven't looked at their insurance in years. And in our practice, we encounter this all the time. We bought it when we got married. Oh, we bought it when we bought the house. Oh, we bought it when the kids were little. And just have a look at it. You recommend checking every 3 years. What exactly should they be checking?
Yeah, every 3 years, at least every 3 years. The following items should be checked. Is the policy still in force? Oh, I forgot. I didn't pay the premiums and the insurance company dropped me. I completely forgot about that. All right. So in force. Change beneficiaries. Add beneficiaries.
Yep.
When you bought the policy, when you bought the policy, let's say it's a 30-year policy, 10 years after you bought it, there was a new addition to your family, a new child, and you didn't add that child as a beneficiary. Forgot to do that. Here's a big one. When I bought the policy, I was
I know where you're
married,
going.
and I named my former spouse as beneficiary, but I never changed the beneficiary to my current spouse. Oh, damn, this happens unfortunately so often.
I know that, Ed. As a matter of fact, there are states that have in their insurance law that in the event of divorce, if no change is made, it automatically reverts to the estate. They will enforce that on the company. So because they were sick of getting tied up in court.
Well, and what happens if the beneficiary dies? Let me share with you. I have an experience. There was a federal employee who came into the federal government around the time I did in the early 1970s, single, enrolled in FedLife, and who did he name? He's single. Who did he name as beneficiaries?
His parents.
Mom and dad, 50-50 beneficiaries. Well, he subsequently got married, 3 children. In 2004, at the age of 54, he died of a stroke. $600,000 of FedLife life insurance proceeds went to who?
I'm going to guess if his parents were still alive, the parents, and if the parents weren't alive, to the estate of the parents.
His parents were both deceased. It went to the estate, which meant that the estate had to be reopened. You're talking, Dan, legal fees, estate costs. His wife and 3 children eventually got the money, but at a big cost and a big delay.
Yep.
Unnecessary. So you have to make sure those beneficiaries are up to date and current. And you
absolutely
got to check. In fact, I would say check that. It doesn't hurt to check every year. It can't hurt. Can't hurt. One other thing that I recommend that employees always get, and I believe FedLife has this, but with some individual private insurance companies, you have to add this. It's a rider. It's called waiver of premium. What does waiver of premium mean? It means that if the policy owner becomes disabled, gets sick, is unable to pay the premiums, okay, that the insurance company will not drop the policy. They're still insured. They're still not insured. Now, when the person is able to pay the premiums and they recover, they'll have to pay the back premiums. But in the meantime, they're not going to lose their insurance because they're unable to pay the premiums. This is a very important rider. I think with the government shutdown, this is what I mentioned. You mentioned about the government shutdown and the employees who have FedLife, they're not being paid. Therefore, their premiums are not being paid to the FedLife premiums are not being paid, but they're still insured. And those premiums will be paid, just like their health insurance premiums will be paid when employees come back and they get retroactive pay. So those premiums will be paid. So employees, don't panic. You still have your FedLife, you have your FEHB, you have your dental and vision, even though you're not being paid. You may be furloughed, not being paid, but you still have coverage.
Got it. Now, Ed, mistake 4 goes back to term insurance.
Yeah.
And you rightly point out that it gets more expensive to renew. So walk us through what your concern is there.
Yeah. Someone initially buys life insurance as well. I know if I buy a term policy and I go out 30 years, it's going to be expensive. So I think I want to get something cheaper, maybe like 10 to 15 years. I think that should be enough for the time being. But then they find out at the end of 10, 15 years, that was a big mistake. They still have the mortgage. They still have a family. They still have to, worry about what happens if they pass away, to pay to raise the kids. Everything I just mentioned still applies. And now their policy, the policy they bought, let's say it was a 15-year policy, is lapsing. And because they came to the end of it. So I still need life insurance. Well, there are a couple of problems here. Can they buy another life insurance policy? Maybe. Are they still insurable? If they're buying private, an individual private life insurance policy, they have to prove they're insurable. Maybe in this period over 15 years, their health deteriorated. Maybe they had maybe a heart attack, something like that. Maybe if they do qualify, I will tell you, it's going to for this policy, it's going to be more expensive.
Sure.
Because they're older. The older you are when you buy a life insurance policy, the more expensive are going the premiums, because the insurance company says, well, now that you're older, you're more of a risk. We have to charge more premiums.
Sure.
And if they have some significant health issues now, could they get the policy? Yeah, but they might be what's called rated. They're going to get a table premium. They're going to be paying kazoo.
Yep. Great points.
What some insurance companies do, though, Dan, is that when they know a policy is coming towards the end within the last couple of years, let's say you bought a 20-year policy. So in year 17, they say, well, your policy is going to come due in 3 years. Would you like to renew the policy, get another 20-year policy? Now, without having to go through underwriting, it's guaranteed issue.
Really? I haven't encountered that.
Yeah. What's the catch? They are going to charge you premiums that are through the heaven. I'm telling you.
Got it.
Even example, I ran across someone who was paying for a 25-year term policy, $1,000 a year. They let it go to year 24. They didn't realize the policy was going to be is going to be over 25 years. They still need the life insurance, so they got a letter from the insurance company. Well, you've been a good customer. You've paid your premiums on time, and now we'd like to renew your insurance. You don't have to go through underwriting. Their premiums, this is what it said, went up to $13,500 a year. For that privilege of guaranteed issue, no underwriting.
That one's going to be pricey.
That's why it takes planning here. Buying life insurance is, it can be a challenge. But I always say working with a professional. I like to say life insurance brokers, not agents, life insurance agents. Because brokers work with all companies. They want to help the person.
Agree. Now, Ed, mistake number 5 might be a surprise to people, and that deals with estate taxes. So what are we looking at here?
Yes. Well, let me start off saying that the United States has what's called an estate tax. It's called the federal estate tax. Exactly what is an estate tax? An estate tax is when someone passes away, there is a tax imposed on the value of the person's estate. The higher the value of the estate, the more estate taxes the estate has to pay. Many people don't realize that the United States had an estate tax 100 years. They got the federal estate tax was established in 1832. When was the United States income tax started?
That was after World War I?
Close, 1916.
Okay.
100 years later. Now, the good news is that the Tax Cuts and Jobs Act of 2017 raised what's called the federal estate tax exemption to, I think they went up to, it was $12 million. I remember when it was $300,000 back in the 80s, but Congress always wanted, certain members of Congress always wanted to get rid of it, but they couldn't. So they kept raising the exemption, $300,000, $600,000. I know during George W. Bush administration, the Congress raised the exemption quite a lot each year. They had a lot of resistance from the Democratic Party, and because the Republicans really wanted to get rid of it. So they came to a compromise. The compromise was that we're going to raise the federal estate tax exemption from $1 million. We'll go to $2 million in 2002, through $3 million in 2003. And then when we get to the year 2010, Dan, we're going to have
lock your kids out of the house.
Federal estate tax. No federal estate tax. But then in the year 2011, it came back to $1 million. So they kept raising up. But the Tax Cuts and Jobs Act of 2017 raised the federal estate tax exemption to, I think it was $12 million, and went up every year. It was supposed to revert back to $7 million at the end of 2025, at the end of the Tax Cuts and Jobs Act of 2017. But the One Big Beautiful Act, which passed the general, raised the federal estate tax exemption to permanently starting $15 million. It'll be $15 million in 2026. It's this year. It's a little less than $14 million. It'll go to $15 million, and it'll be raised each year by inflation. That's the federal. So here's my point. A couple points here. What is included in your estate? What is included when an individual has, and every individual has an estate. What's included in your estate? Your
everything you own. Everything you own.
Anything you own. Real estate?
Yep.
Cars?
Yep.
Heirlooms? Jewelry? Tools?
Yep.
Bank accounts?
Yep.
Brokerage accounts?
Yep.
IRAs?
Yep.
Just traditional or about Roth?
Yes.
Yes. Roth. TSP?
Yes.
TSP? Yeah. Yeah. So we potentially, it can add up. It can add up. Can add up. Okay. So, but it's extremely rare that someone in this day and age has an exemption. Someone died this year. What are the chances are that they're going to have an estate that's going to be over $14 million? I don't think so. Also, if you're a married couple, you can double that exemption for the second one. So that's $28 million. Here's the situation, though. In addition to the federal government, there are 12 states and the District of Columbia that have their own state estate tax. Some of these states have low exemptions. Massachusetts has a $2 million estate tax exemption. Oregon has a $1 million. Oof. I think both of us live in Maryland. You know what the Maryland tax exemption is? Or estate tax exemption is? $5 million. Now let's think about it. Here we live in Maryland. A federal employee lives in Maryland. Okay? Federal employee owns a house.
Mm-hmm.
Just a house. $750,000?
Sure, or more.
They have a rental. They have a rental property, maybe, or a second home, vacation home at the beach. Maybe add another $500,000 there, so we're over $1 million.
Yep.
How much money do they have in their TSP accounts?
Well, if they've listened to you, they're well over $1 million.
Well, over $1 million, right? I think the latest count there's like 137,000 TSP account owners worldwide with over $1 million in TSP accounts. And we forgot something. Life insurance. If you own a life insurance policy, you're the owner. You're the policy owner. You're not the beneficiary. You're the owner. When you die, the amount of that life insurance that's on you is included in your estate. I know someone here in Maryland has a $3 million life insurance policy. $3 million. It's a term policy. Add it to the other stuff. By my count, Dan, that's over $5 million. So if you want to minimize the possibility of being subject to estate tax, federal estate tax, what can you do? Well, one thing you can do when it comes to your life insurance is don't be the owner. You can assign ownership, because if you're not the owner of the life insurance policy when you die, it will not be included in your estate. So you assign ownership. I remember a couple of years ago, this goes back more than a couple of years ago, 20 years ago, when I had a $1 million life insurance policy. I bought, privately. And at that time, the estate tax exemption was about $600,000. And I was really worried because we had a house, investments, things like that I was worried that life insurance policy would be included in my estate. So what I did was I went to an estate lawyer, and the estate lawyer set up what's called an irrevocable life insurance trust, in which I had a friend of mine he was now the owner of the life insurance policy, in which he would put the premiums would be, I would gift the premiums to him, and he would put it into the trust. The trust would pay the premiums. This way, if I passed away, it would not be included in my estate. So there are things that can be done. Or you could just sign ownership. When you sign ownership of your policy to someone else, then you're no longer the owner. Now, when you're no longer the owner, keep in mind, you can't change the beneficiary. You're no longer the owner. You don't have to pay the premiums. So who pays the premiums? The person you sign it to. You have to gift them. You have to gift the premiums to them to pay the premiums. So there are ways to minimize the possibility that your life insurance policy will be included in your estate when you pass away.
Gotcha. Now, Ed, our next three mistakes all revolve around beneficiaries. And the first one is naming minor children as beneficiaries, and that can get nasty.
Yeah. Dan, I know you got more experience than I have in this because you work with insurance companies. Do you know of any insurance companies that's going to pay $500,000 to a 6-year-old?
They don't like it. Mm-mm.
I don't think so.
And the courts will step in, and they'll pick somebody, and maybe that's somebody you want, and maybe it's somebody you don't want.
Yeah. I think that's a mistake that some people they name their minor children as beneficiaries. Another problem is in general when it comes to, I say, bequesting your assets when you have a will or trust like that. Equal is not, and I always say, equal is not necessarily equitable. Especially when it comes to children. Each has their own needs and so on. You don't have to always give them the same amount. They may have different needs. And I asked a question to someone who says to me, I want to make my children the beneficiaries of my life insurance policy. Should each child receive equal shares? Should each child receive their share outright? How do you want it to be paid out? In other words, you may have a child that's financially irresponsible. Do you really want them to hold that money? To handle that amount of money? Are children mature enough to handle such a large amount of money? I mean, technically speaking, a child, when they become 18 years old, is an adult, and they could be the beneficiary of your life insurance. An 18, 19-year-old, 20-year-old in college, I mean, they get their hands on their money. They may take the money and buy a Ferrari. You know what I mean? So, I mean, you got to ask yourself the question, before you name your children outright as beneficiaries.
Gotcha. Now, again, staying in the beneficiary vein, this next one, oh boy, I see it, Ed, and it always makes my eye twitch. And that is naming the estate as beneficiary.
Oh, God. When you do that, congratulations. If it's a state that you live in, has an inheritance tax, the life insurance proceeds are going to be unnecessarily subject to state inheritance taxes. That is, congratulations. You just are going to give as a result of doing that, you're going to give your ultimate beneficiaries less money. You made the state's tax budget deficit less by doing that.
Yeah. Well, plus, Ed, then you got probate expense with it, where before it would have just passed by operation of contract.
Unnecessary, Dan. Unnecessary. That really is not the way that things should be done. That's the worst thing. You never name your estate. And what happens a lot of times when it goes into when the proceeds are paid into the estate, an irrevocable trust will be set up to capture the proceeds of the life insurance. Life insurance. That's what the insurance companies sometimes do. And the insurance company is obligated to pay, while it's sitting in the trust waiting to be paid out to beneficiaries, the insurance companies have to pay interest on the life insurance proceeds. Now, there's a problem here. A trust is a tax-paying entity. And you don't want a trust to pay taxes because the trust tax rates are sky high. Let me show you why. If you are an individual and you're paying income taxes, the highest marginal tax bracket is 37%. if you file a single, how much of taxable income will you have to have during 2025? Look at the tables here. In order to pay 37% tax when you're on your, that's the highest rate, In 2025, we're talking about your taxable income, not adjusted income, but taxable income would be over $608,000. If you file as married filing jointly, over $730,000.
Gotcha.
That's married filing jointly. A taxable trust, a trust that's going to pay taxes. How much taxable income would the trust have to have in 2025 to pay 37% tax?
I'm going to guess $1,000.
A little more than that, $14,000.
Okay.
Here you got $2 million worth of life insurance proceeds getting interest. It's money thrown away.
Yep. Ouch.
So,
and finally, Ed, still in the beneficiary vein, mistake number 8, failing to name contingent beneficiaries, and you offer something called the rule of 2. Tell us about that.
So, you have a life insurance policy, and you want to name beneficiaries. That's great. You have your beneficiaries. You know who your beneficiaries are, and you have, let's say, 4 of them. Each is getting 25%. That's wonderful. What happens if one of the beneficiaries predeceases you? Then what happens? You only name primary beneficiaries.
Now you're going to the estate.
And then go back to your estate. So here's a suggestion. For every primary beneficiary you name what's called 2 contingent beneficiaries. This way, when one of the primary beneficiaries passes away, the first named contingent beneficiary steps in. Okay, steps in to take the place of that beneficiary, and then the second contingent beneficiary will move up to the next, and then move up one, and so on. This way, you're covered. And I'm mentioning this for life insurance, but it applies to other things. For
Absolutely.
example, the TSP. Name beneficiaries of the TSP. You name primary beneficiaries and you name contingent beneficiaries for every primary one. Traditional IRAs, Roth IRAs, even bank accounts. You could do this now. You have a POD. You have a POD, payable on death, on a bank account. That's the person who would receive the money in your bank account without having to go through probate. Name a primary beneficiary and a contingent beneficiary. I know you work at the brokerage, Raymond James. TOD, transfer of death. Can you name a primary and then a contingent on a TOD? Yeah. So this rule of 2s, Dan, I call it rule of 2, in which 2 backups are named as beneficiary, is a good practice for all accounts. Rule of 2s. Always name 2 backups, 2 contingent beneficiaries for anything you can name a primary beneficiary.
That's a great tip. Well, sir, you've done it again. You've identified some things that could really be some costly mistakes, could devastate families. And on behalf of all feds, thank you for doing it. This is exactly the type of practical guidance that feds need to get and rarely get elsewhere. So thanks for doing it with us, and thanks for doing it for the feds.
My pleasure. Thank you.
Well, folks, that's a wrap. We are, say it with me, serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. And please remember to share it with your friends and strangers. Don't forget our live webinars every single week. As I say, head over to swserve.com. You'll see the webinar button. Click it. It brings up the whole menu. And don't miss Ed every single week in the Fed Zone. That's fed-zone.com. The guru comes to you, reach you where you are, teach where you are, and above all, serve you where you are. With those webinars, sign up for one, sign up for all, share with your friends. They will thank you. So for Ed, the guru at Serving the Serve, and me, Dan Sipe, I'm going to sign off as I always do, and especially in times like this with shutdown. Good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you absolutely positively deserve it. Stay well, everybody. We are out.